Types of market analysis. There are three types of market analysis: fundamental analysis, technical analysis, and sentiment analysis. It is important to understand and implement all three types of analysis. Individually, they all have their strengths and weaknesses, but the key is to find the right balance between them. Fundamental analysis in Forex is the study of a country's economy to determine the effect it has on the value of its currency. It is the process whereby factors impacting the economy, industry groups, and companies are examined. Fundamental analysis can be quantitative or qualitative. Quantitative is data that can be measured or expressed in numerical terms, such as economic data or financial statements. Qualitative is data that cannot be expressed as a numerical value, such as fiscal policies, company structures, or current affairs. Technical analysis is the forecasting of future price movements based on the analysis of past price movements. It tells the trader when to pull the trigger and execute a trade. It uses a wide variety of charts that show price over time to help traders anticipate where price may be heading next. There are many types of technical analysis techniques, and it can be as complex or as simple as you want. To avoid information overload, we will concentrate on what we use. We look at chart patterns, indicators, and intermarket analysis. Price is possibly the most powerful indicator of all. Patterns can form, which presents an opportunity for a trader to enter the market. Patterns always form and repeat themselves, so when they do appear, it's important that the trader can recognize them and take action. The pattern itself reflects the market sentiment and can be used to predict where price might be heading next. We use Elliott wave theory to help us identify recognizable patterns to forecast future price movements. It is a method of technical analysis based on the idea that the market forms the same types of patterns on a smaller time frame than it does on a larger time frame. Indicators are either lead-in or lag-in. A lead-in indicator gives a signal before the new trend or reversal occurs. A lag-in indicator gives a signal after the trend has started. Intermarket analysis involves analysing multiple different asset classes. The objective is to determine how one asset class impacts on another. Price action of currencies is often driven by their relationship with equities, bonds, and commodities. We analyse the S&P 500, US dollar index, gold, oil, and US Treasury yields. This helps us give a broad perspective of the market. Sentiment analysis defines how investors feel about the Forex market and takes into consideration the collective risk appetite of the market participants. The market represents what all traders are feeling, expressed through their positions they take. Apart from trying to gauge a general feeling from news channels, social media, blogs, and reports, we use a few tools readily available to us. The Volatility Index measures the implied volatility in the S&P 500 options. Sometimes called the fear gauge, it is often seen as a broad-based predictor of the market's risk appetite. The Commodity Futures Trading Commission publishes the commitment of traders every Friday. It measures the net long and short positions taken by speculative traders and commercial traders. It gives us an insight into the positions taken by market players. There are many different types of analysis, and we have only touched upon what we use. We believe that by combining fundamental, technical, and sentiment analysis in a clear, balanced, and methodical way provides the best opportunity for one to profit from the market.